Is the Ageas Federal Smart Growth Plan truly a smart way to grow your wealth or just another ULIP dressed in fancy terms? Let us find out the answer to this question through an in-depth analysis in this video. Hi there, welcome back to holisticinvestment.in, where we help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand a few basic details about it. This is a unit-linked, non-participating individual life insurance plan, and some of the key features of the policy are: it provides you with life protection along with market-linked returns, and offers flexibility through regular or limited premium payment terms. It allows you to choose your preferred premium payment frequency. It also enables selection from 9 fund options based on your risk appetite. It enhances your fund value through guaranteed loyalty additions, and there are also tax benefits available under Section 80C and 1010D of the Income Tax Act. And there are also benefits like maturity benefit and death benefit and guaranteed loyalty additions, which depends on the plan option you have opted for. There are also investment strategies and 9 fund options for you to choose from based on your risk tolerance, your financial goals, and time horizon for those goals. So as a unit link policy, there are also certain charges you need to pay for, like premium allocation charge, policy administration charge, mortality charges, fund management charges, and also discontinuance charges. So these charges are deducted from your premium, reducing the amount actually invested. Consequently, the deducted portion loses the opportunity to earn compounding returns over the policy term, leading to a lower overall corpus and diminished final return. So we need to consider this as a drawback. So some of the advantages are: partial withdrawals are permitted after 5 years, allowing access to funds in case of emergencies. The settlement option enables you to receive your maturity benefits in periodic installments or a maximum period of 5 years. You have the flexibility to switch between funds any number of times without incurring any charges. At any point during the policy term, you can also redirect future premiums in a different allocation ratio as per your changing investment preferences. So these are some of the advantages. However, there are some disadvantages, like policy loans are not allowed under this plan, and there is no liquidity available during the initial policy years. The sum assured offered is also inadequate to meet financial protection needs, and the returns are not commensurate with the level of risk involved. So the premiums invested are only after deducting various charges, reducing the effective investment value. So these are some drawbacks that you need to keep in your mind before deciding to invest in this policy. Now, as we have a basic idea about it, let us move on to the analysis part of the video, where we are going to conduct an IRR analysis based on the policy brochure's benefit illustration to help us make a more informed decision. But if you still want to know more about certain aspects of the policy in detail, you can refer to the policy brochure. So for calculation purpose, let us assume that a 35-year-old male has invested in this policy with a sum assured of 5 lakhs, a policy term of 20 years, and a premium payment term of 10 years. So the annual premium is 50,000 rupees, and he has selected plan option 2 plus. So if he pays premiums regularly, he becomes eligible to receive the fund value along with guaranteed loyalty additions at the end of the policy term. So here in the policy brochure, they have provided 2 scenarios based on assumed annual returns of 4 and 8% per annum. These rates are purely for example purpose and they are not guaranteed. This is just to show how a unit link policy can perform at a worst and best case scenario. So at 4% per annum, the fund value is projected at 6.28 lakhs, resulting in an IRR of 1.48% as per the policy's maturity calculator. At 8% per annum, the fund value is projected at 11.64 lakhs with an IRR of 5.53% as per the policy's maturity calculator. So both scenarios yield returns that fail to outpace inflation, thereby eroding real purchasing power over time. Moreover, the plan's high charges and lack of transparency in underlying investments further diminish its attractiveness. So considering the low returns and limited liquidity, this policy appears unsuitable for building a meaningful corpus to achieve medium to long-term financial goals. As this policy is not giving us a desirable outcome that we need, let let us move on to a comparative analysis where we are going to take up an alternative approach in which we are going to invest in insurance and investments separately instead of combining into a combined policy like Ageas policy. Here for life cover purpose, we have opted for a pure term policy providing with 15 lakhs of life cover for a 20-year term with a 10-year premium payment period which costs us an annual premium of 10,100 rupees. So compared to paying 50,000 rupees annually under the ULIP, this approach saves us 39,900 rupees each year, which can be instead invested according to one's risk appetite. So high risk investors can invest their savings in equity mutual funds. Risk averse investors can opt for debt instruments like the Public Provident Fund (PPF). So for this comparison, let's consider equity mutual funds for the equity route and PPF for the debt route. So the PPF account requires a minimum contribution of 500 rupees per year and runs for 15 years. Since the ULIP's premium payment term is 10 years, adjustments are made in the final year's contribution to align the periods. The final maturity value in the PPF account works out to be 11.76 lakhs, yielding an IRR of 5.60%. Although this IRR is close to the 8% scenario of the policy, PPF, being a low-risk debt instrument, still outperforms the ULIP on a risk-adjusted basis. So in the case of equity mutual funds, the pre-tax maturity value is 24.35 lakh, while the post-tax value after capital gains tax calculated stands at 21.96 lakh. So the combined IRR from the equity mutual fund investment plus the term insurance policy is an impressive 9.77% calculated on post-tax returns. So if you want to know how we have calculated tax for equity mutual fund, you can see that we have presented a small tabular column on the screen for your easy reference, which you can pause and see. So this accumulated corpus is almost double that of the Ageas policy's 8% return scenario, and the IRR comfortably exceeds the inflation rate. Overall, this alternative strategy, combining a pure term life insurance policy with targeted investments, often perform better transparency, higher post-tax returns, and superior risk-adjusted performance aspects that the Ageas policy fails to deliver. So what is the final verdict then? Is investing in the Ageas Federal Smart Growth Plan worth it or not? So this is a typical unit-linked insurance plan that comes with two variants. Under plan option 1 Prime, the death benefit is limited to the fund value, while plan option 2 Plus offers both the sum assured and the fund value as the death benefit. In both options, the maturity benefit comprises the fund value along with guaranteed loyalty addition. However, the plan's risk-return trade-off is not balanced, especially for a long-term investment. The returns generated are relatively low compared to the level of risk undertaken, and it also has a high agent commission. So this policy is not ideal for wealth accumulation, and investors may find themselves falling short of their financial goals when they come due. The combination of modest returns and limited liquidity makes this plan an unattractive investment choice despite its name. The plan falls short of being a truly smart growth solution. So if you want to be a smart investor, it's wiser to explore cost-effective equity-based investment options that deliver superior inflation-beating returns. For life protection, it is best to separate insurance from investment. A pure term insurance policy will offer you with comprehensive coverage at a fraction of the cost.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.